Hello everyone, this is Ashish with Investor Friendly CPA, and let's discuss out of state investing. We get this question a lot and it's confusing because state have different taxes and people really get confused if they invest out of state. Okay, before talking about this complicated area, what I want you to understand is this. First thing is, you always have to pay taxes in your state. Doesn't matter where you earn your money, you always have to bring that income in your state and pick up the income in that state, right? Now, how does that relate if you have a property, a rental property, let's say in another state? That's what we're going to talk about. Let's give an example. I live in Georgia, and let's say I have a property in another state, North Carolina. This is how it works. You always, first of all, have to pay taxes in the asset state as well, right? You have to source your income to the state where you make your money. So North Carolina is they're going to tax me on my rental income. Now again, as I had mentioned before, I also have to pick up the income in my state, which is Georgia. Do I pay double taxes? Because North Carolina already taxed me. What happens to Georgia? Luckily, all of the state will give you credits for the taxes that has already been paid to other state. So what does that mean? So let's say I already picked up all the income in North Carolina, I'll pay all the taxes there. Now when I file my own return in Georgia, what happens is I get credit for the income and taxes that I already paid to North Carolina. That's the basic concept, right? So the next question I get is, how, if I live in non-taxable state or invest in non-taxable state, can I avoid taxes? So think about this. You always have to pay taxes in one state, either your asset state where your asset sits or your residence state where you live, right? If either of them is non-taxable, it doesn't make a difference, because if you had paid taxes, you would get credit. Now, if you're investing in a state that does not tax you, then you just don't get credit, but you still have to pick up that income in your residence state where you live, right? So let's talk about an example. If I'm in Georgia, so let's move my example from North Carolina, which is taxable state, to Florida, which is non-taxable state, right? If I live in Georgia and if I invest in Florida, Florida is not going to tax my rental income because it does not have an income tax, but I have to pick up that income at my Georgia state tax return. Since I did not pay any taxes to Florida, I don't get any credit, so I still pay taxes out of Georgia, right? Now let's reverse this. Let's say I live in Florida, which is non-taxable state, and I invest in Georgia, which is taxable state. What happens? I have to pay taxes in Georgia because my asset sits in Georgia, and when I go back to Florida, Florida does not have any income tax, so I don't have to pay taxes there. So I still pay taxes even though I lived in Florida. So the only way to avoid state taxation is to live in a state that's non-taxable and also invest in a state that's non-taxable. Otherwise, you will pay taxes. Okay, and this example is mostly for rental real estate. If you are, if you have other businesses, such as, if you have, restaurants, or if you have, manufacturing business, if you have, trucking business, then you have to do something called allocation and apportionment. It's complicated. Your advisor is going to help you with that. But that's how it works with out-of-state investing. Hopefully, this was helpful. It is confusing, so I want you to reach out to your own tax advisor to clarify this. If you want to ask us, we're more than happy to help you. Just find us through all the links below, and we will get in touch with you. We'll see you in the next video.